video of Stock Basics 101, we're going to go over options. Okay, disclaimer, none of this is financial advice, everything is at your own risk. Using options is very volatile and in most cases results in 100% capital loss. Right, so what are options? Options are the secret weapon of investing. They can get you seriously wealthy relatively quickly. Some Tesla investors went from even less than this, 100,000 to 1 million to 100 million using this approach, okay? This is serious. But the same returns are not likely going forward, but it's still absolutely nuts. Options can get quite complicated. There's call options, put options, spreads, naked spreads, there's all these different things. But the most simple version, and in my opinion, the only one that you really need to understand is call options. These allow you to buy a contract, which is an option, not an obligation, to buy a stock at a specific price in the future. For example, a 1,000 strike price call option on Tesla for January 2024. The closer these options come to the current date, the more of them there is. So for example, there's one every Friday for the next few months, but if you go out 6 months, 12 months, 24 months, they're kind of every quarter. Okay, what's the benefits? Options can be used, well, call options specifically can be used in two different ways. One, you believe a stock will appreciate a lot and you believe it's a long-term hold and you want to secure the price you pay in the future, effectively a lock-in for what you'll pay. Or option B, you want to trade and make a high return really fast. Options can give you an unbelievable return. It's on average 2 to 3 times the stock appreciation if you were to put that same money into the stock versus buying options. But it can also be up to 40, 50x. So it's pretty crazy. Okay, so option A, this is my approach. This is what I'm doing. Buying options to accumulate more of a stock. So for example, today you buy Tesla at 1,000 strike price. You buy Tesla options at 1,000 strike price for January 2024. These currently cost 173 each. I think these may have even gone up in the past hour that I'm doing this, but anyway. So for 100 contracts, because you must buy them in chunks of 100, you can't buy them as single contracts. It will cost you, obviously, $17,300 in option premium. This just means the cost to you today. That's what you have to invest today. In January 2024, when, in my opinion, I believe the stock will be around $3,500 or more, and I exercise those 100 options I bought, these are 1,000 strike price, so I need to spend $100,000 because there's 100 of them and they're 1,000 each. So the total value of these 100 shares, though, because the stock is now 3,500, I think it will be, that's $350,000. So let's go over this. What's the numbers? So I invested 17,300, and then at the end of the term, the 2 years, I'm investing another 100,000. So the total cash in is 117,300. But the current value is 350,000. So the profit on that is the difference, which is 232,700. So the return on that is around 2x. Annualized, that's 72%. An annual return of 72%. Now, exercising options is a non-taxable event. Okay, I'll say that again. Exercising options is a non-taxable event. So when you exercise them and convert them into stock, you are not paying any tax on that profit. It is not treated as a capital gain. This is the power here. Now, we'll go into a bit more detail. What if I use margin to exercise the options? As in, the only cash I put in is the option premium today, and then when I exercise them in 2 years, I use margin to do the exercising. Now let's go through that. So in that example, the value would be around $350,000. The profit, if you take it all into account, is around 232,700. So the return is 13x. So 17,000 in, 232 out. That's annually a 380% return. Now, note that you would obviously need enough assets in your account to take out margin to be able to exercise the option, but technically the value of the options would be can be used as collateral. It's a different percentage, but roughly it's enough. But what if Tesla hits 30,000 a share in 2030, and I use margin to exercise those options in January 2024? Well, the profit would be 2.9 million by 2030, a 173x return. 173x return, an 85% compound annual growth rate on the money that went in. I think now you understand why I'm using this strategy with like a third of my portfolio. Okay, option B. Option B is what options were originally created for. So buying and selling options to make high returns. So for example, you buy the options today, the same price, but in January 2024, you sell the options. You don't exercise them. You sell them on the market because someone else wants to come in and say, yeah, I want to buy some of the stock at 1,000 per share. I'll pay a cost for that, which is less than just buying the shares whole outright right now. So you can sell them on the market. Now, in this example, you invested 17,300. The value of the options is around 250,000. So the profit is 229,000. The return is 13x. Again, a very similar return. It's pretty amazing. But this is obviously taxable. So your actual return after paying tax, instead of being 13x, is 10x. Well, a 10x in 2 years is still pretty nuts, right? That's great, but what if you use margin to buy the options? So even the options you bought with margin. Then obviously the returns are infinite because there was no capital in. So this is what a lot of people do. The problem with that is it's very dangerous because then you've got leverage on options, and options have volatile prices day by day. And you can obviously only have so much margin when your only assets are options. So it's quite dangerous. Okay, why do this strategy over the other option? Well, long term, if those shares you believe you're buying options in are going to be worth a lot in the future, in this example, Tesla, 30,000 per share, then it's ridiculous to sell the options because you're forfeiting, you're taking a short-term profit for something that's going to be 10 times that profit. It's going to be 173x return on your money. Also, there's no tax implication on those returns over, let's say it gets to 30,000 per share in 2030. There is no tax implication because you exercise the options. This is the problem whenever you sell something, is then you have to do something with that capital. And this is the core principle of investing, your compound annual growth rate for each dollar. If you sell, then you've got to invest the money and you've got to beat this return of 173x potentially into something else. So that's why I don't follow option B. I obviously follow option A, but I'm obviously very bullish on the stock. You may have a different opinion in the future. So that allows you to sell them and take your profit and put your capital elsewhere. So what's the downsides? 99% of options expire worthless. Even some of the best Tesla investors who made 100 million in the past few years, they admitted that they were using these options 5-6 years ago when the stock wasn't moving for 4 or 5 years, and they had like accounts that were 100 grand that went down to 10 grand. This is the problem with options, is they are, in most cases, you will lose money. If the stock doesn't hit the strike price that you think it will, or above it, then you will lose all the invested capital. I mean, it's technically the strike price plus the premium that you've paid. And these long-term options are better because they're safer, they do cost more, but the problem with them is they depreciate in value. They have a daily cost. And there's all these other statistics that are used, but ultimately there's a cost that they depreciate at each day, and that varies over time. But if you're obviously following option A to accumulate more stock, then you don't really care if the value of those options is $1 and you paid $20,000, it doesn't matter, because when you exercise them, you know that the price is going to be so much higher that it's not going to make a difference. Then the other most important thing about options to understand is they are like the casino. They can be used in quite negative ways and they can become addictive. So you need to be a really cold, calculating investor, and you need to have full control of your emotions. This is how people lose all their money. This is how most investors have lost their money over history as well. So in summary, 99% of options expire worthless. Options are incredibly powerful, but very dangerous. If you use Tesla and options with margins to exercise them, 17,000 invested today could become in 8 years, in 2030, 2.9 million. I repeat that. Using Tesla options and then exercising with margin, 17,000 invested today could become 2.9 million in 2030. Technically, that's the profit. It's actually more. Use optionsprofitcalculator.com to calculate all options. It allows you to type in a stock, pick all the options that are available. Let's say January 2024 Tesla, 1,000 strike. And then you can put in a range of where the stock price could be at that time, and it will calculate all the eventualities, where you lose money, where you make money, the amount of profit, the return. It does everything for you. It's completely free. Go use it. If you're following strategy B, you can also use shorter timescales to maximize your returns. But if you are going to follow option B, which I don't recommend anyone does, but if you do, then know your entry price and know your exit price and before you make the trade, because after you make the trade, you become invested, you get bias, and your emotions take over. So you need a plan before you go in. And that's it. So thanks for listening. If you have any questions about this, I know it's complicated. I've tried to make it as simple as possible. This was a subject that took me quite a long time to understand. Please comment below any questions you have. It doesn't matter how simple they are. I will respond to them. I will try to help. I'll try to make it really simple for everyone. I think options and margin, which was the previous video, if you haven't watched that, go watch it. I think these two principles are extremely important to learn as someone trying to retire early and as an investor in general. These are the secret weapons that we're never taught. These are the things we're not taught in school. So any questions you have, please comment them below, and I'll respond, and I'll try to help as much as I can. Thanks for watching. If you found this useful, please like and subscribe. Trying to get to 1,000 subscribers. Really appreciate your help. Share this on social media so more people can see this content. I really think these principles are the most important thing to learn about investing, and I think it could really help a lot of people. So help me spread the word. Yeah, and I'll see you on the next video.